Hey there! Today we're going to tackle a topic that's been making a lot of noise lately, capital gains tax, or CGT. Now, it might sound a bit dry, but stick with me because we are going to break it all down.
So let's jump right in. Capital gains tax has been around since the mid-'80s. So why is it suddenly everywhere? Why is everyone talking about it now?
Well, it turns out there's kind of a perfect storm of three big things happening at once. First up, you've got whispers of potential changes coming in the next federal budget. Then there's a Senate inquiry that's basically putting the entire system under a microscope. And finally, the big one for so many of us, the relentless ongoing conversation about the cost of housing in Australia. These three things are colliding, and it's pushed capital gains tax right back into the spotlight.
Okay, so to really get what all the fuss is about, we've got to go back to basics. What even is capital gains tax?
At its core, it's pretty simple. It's the tax you might have to pay on the profit, the gain, you make when you sell an asset. So you buy something, let's say some shares. They go up in value. When you sell them for more than you paid, the government wants a slice of that profit. That's your capital gain.
Now, this is probably the single most important thing to understand, and it's where a lot of people get confused. CGT is not some separate tax you get a bill for. It's actually just part of your normal income tax. Any capital gain you make just gets tacked on top of your other income for the year, and you get taxed on the whole lot at your usual rate.
Of course, there are some big rules and exceptions. The biggest one by far is your main residence. Yep, your family home is generally exempt from this tax, which is huge. Also, anything you owned before the tax was even invented back in 1985 is usually safe. The tax gets triggered by what the ATO calls a CGT event, which usually just means you sold something. And it's not just about property. This applies to shares, managed funds, and yes, even your crypto.
You know, the system we have today, it wasn't always like this. To understand the current debate, it helps to take a quick trip back in time and see how we got here.
So why do we even need it in the first place? Well, it was all about closing a massive tax loophole. See, before 1985, you paid tax on your income, but not on capital gains. So people got creative. A company could pay a worker in shares instead of a cash bonus. The worker could then sell those shares a day later, and that profit, totally tax-free. CGT was brought in to make sure that $1 of profit was taxed no matter what you called it.
Looking at the history, there are really only two dates you need to know. 1985, when it all began, and 1999. That's when a massive change happened, creating the exact system that we're all talking about again today. And this slide lays it out perfectly. Before 99, we had this system called indexation. It was designed to only tax your real profit after accounting for inflation. It was fair, in theory, but it was an absolute headache to calculate. So in 1999, the government scrapped it for something much, much simpler, the CGT discount.
And this is the number: 50%. This is the figure at the absolute heart of the entire modern debate. The rule is incredibly simple. If you're an individual and you've held an asset for more than a year, you get to slice your capital gain in half before it even gets added to your income. That 50% discount is the whole ballgame.
Okay, so let's connect all this tax talk back to the real world, specifically to the housing market, because this is where the debate really fires up. If you're a property investor, the logic here is pretty powerful. That 50% discount is like a huge incentive. It makes the profit you might get from a property's value going up way more attractive than, say, the rental income you get along the way, which gets taxed at your full rate.
But if you're trying to buy a home to actually live in, you might see it differently. The argument is that if the tax system encourages more people to become investors, it just means more bidders at the auction, more competition, and potentially higher prices for everyone.
And this quote really hits the nail on the head. This is the core of the concern. Has the 50% discount, designed to be simple, accidentally tilted the playing field so much that it's just plain harder for regular homebuyers to get into the market?
And what about renters? Where do they fit in? Well, the connection is a bit more indirect. But essentially, if you change the rules for investors, you might change how many investors are in the market. And that, in turn, can affect the number of rental properties available, which could eventually have a knock-on effect on rental prices.
So all of this brings us right back to today. With all these competing pressures, investors, homebuyers, renters, the budget, what happens now? What does the road ahead look like?
All right, let's do a super quick recap of the most important things to remember. 1. CGT is just part of your income tax. 2. Our whole system is built around that 50% discount that started back in 1999. 3. It's under review right now because of that Senate inquiry and all the budget talk.
And 4, when people argue about CGT, they're very often really arguing about housing.
And that really leaves us with the big final question. We're now taking a hard look at a rule that's been in place for a quarter of a century, a rule that has shaped our economy and our cities. The real challenge now is figuring out what's the right balance. For our economy, sure, but also for our homes and for the kind of future we want to build.